Hey, Archie, I've got some facts about the stock market that I think might surprise you.
Well, Rob, that sounds great. I hope they're fun.
Weekly wisdom to help you retire and stay that way. This is Last Paycheck.
Welcome back to the Last Paycheck Podcast, brought to you by Hoxton Planning and Management. We're your hosts, CFP professionals Archie Hoxton and Rob Hoxton. And today we're going to be talking about fun facts about the stock market. We think they're fun. I guess if you're a finance nerd, that's kind of might be your definition of fun too. But
some of them really surprised me, and if it hadn't been but for the source that it came from, I might have wondered if it was actually true.
Right.
These all came from a friend at Goldman Sachs, and it comes from research from Goldman Sachs Investment Research Department. So we think that that's probably a pretty good indicator that this is not made up stuff.
Right. Well, and they're interesting angles. I think it's easy to look at something about the stock market and, the average rate of return, X or whatever. But there's so much complexity, and so you can look at it from different angles. So these are some cool angles to view it from.
Yeah, and we tend to think that whatever it is that we're experiencing right now, we're like seeing something new. And really, there's the old saying, there's nothing new under the sun. I mean, when we see the market go up or we see the market go down, we see our account statements gain value or lose value temporarily. We think that maybe we're experiencing this for the first time, and it's that's definitely not the case.
Or this time it's different.
Yeah.
So, well, let's look at the first one. This is interesting. This goes back to 1945. So since 1945,
the end of World War II, basically.
Yep. The S&P 500 has averaged on an annual total return basis 13% average per year. Also, 79% of all those years between 1945 and now generated positive returns.
So, this is going to air in January of a new year, 2026. And if you're thinking about what is likely to happen in the stock market, well, you should know that in any given year, you have 4 out of 5 years are going to be positive.
Yeah. Or another way to think of it is 4 out of 5 odds of a good year.
Yeah.
2025, the S&P, as of the filming of this, was up 17%, which puts it in the 56th percentile of all those years. So it's actually like kind of a middle of the road year for the S&P 500, which is kind of amazing.
Yeah.
It's better than 56% of the other years in the data set. So it's kind of amazing.
And since we're talking about the S&P 500, it's easy to think that the S&P 500, which is the most widely followed index of the stock market, and it's U.S. companies, the 500 very large U.S. companies. And when you think about it, you'd think, well, this is probably the same 500 U.S. companies today as we had in 1945, but that's definitely not true. In fact, here's a really fun fact. In what's sort of thought of as a survival of the fittest type story, if we just look back to 1999, which was 26 years ago, just 193 constituents of the S&P 500 are still in that index. So there were 500 stocks, 500 companies in the S&P 500 in 1999, but only 193 of them are actually still in the index.
Yeah.
There's a lot of turnover there.
There is. And every once in a while, you'll hear about a company kind of moving into the S&P 500 and somebody getting kind of relegated out of it. It explains that, when you have these great companies that you think back, we're at one point viewed as like the Apple or NVIDIA of the day back in the old days. And now, it's kind of a boring, maybe it doesn't grow much, pays a little dividend. Still an important company, but, as companies come and go and new companies come in, that's why if you own the S&P 500, it can just continue to grow. Even though when you look around, there are lots of old established companies that have maybe kind of plateaued. That is not necessarily how the S&P 500 works. It is to a degree.
Rotating
in and out.
Jimmy in our office made the point that it's kind of like having an actively managed mutual fund, really. If you have the S&P 500 and it changes over time, the management piece of it is basically deselection by the company. So if the company really performs poorly, or they fall in hard times, or there's a merger or something, they may be removed from the S&P 500 index. And we see that happen, in any given year. There's oftentimes news of that happening.
Yeah.
It wasn't that long ago that Tesla was added to the S&P 500.
Right.
And that statistic is even more amazing when you think of the NASDAQ 100. So if you think of the NASDAQ 100, you think of tech companies. If you go back to 1999, only 19 of those are still in it.
Yeah, less than 20%.
Yeah, so
have remained.
Yeah,
it's pretty amazing.
It is pretty cool.
Just hanging out on the S&P 500, which we'll spend a good amount of time talking about that because it is probably the most important index. If we look at this 1945 to today time frame, it's interesting to look at if you had invested $1,000 and then different decisions you could have made along the way and how what result you'd have today. So if you put your money in the S&P 500 in 1945, $1,000, you'd have $7.3 million today. Now, it's also worthy of note that the S&P 500, when we say that, we're talking about similar indexes. These indexes have changed since then. The market's a lot different, both in the company level and also in how we're measuring the largest companies in America. That has changed. So we say S&P is sort of in this case, capturing that subset of companies. But so if you invested $1,000 in 1945, you'd have $7.3 million today. But that's only if
there's a few catches to this.
Right. That's only if you stayed invested the entire time and reinvested your dividends.
And reinvested your dividends.
So there's a cyclical nature to the markets. So let's say instead of that, let's say you bought in November and sold in April, and you did that every year. That $1,000 investment today would only be worth $462,000.
Wow.
So missing that middle of the year chunk, that April to November, would give you a fraction of the return. And it's even crazier if you did the opposite and you bought in May and sold in October.
So it's really tempting to say that maybe we should only be invested in November.
Right.
But that you would be missing the whole point here. There's not much of a pattern. You hear about Santa Claus rallies, you hear sell in May, invest in, sell in May and go away or something like that.
Yeah. There's an old saying like that.
Yeah, and it varies from one year to the next.
Right.
So the point is that you gotta be in it, you gotta stay in it, you gotta reinvest dividends, or you just don't the numbers for not reinvesting dividends. So if you're only getting the appreciation and not reinvesting the dividends, the numbers are much different. It's not 7.3 million.
It's $500,000.
It's $500,000, 500,000. So the dividend piece of it is hugely important.
Right. That's your kind of buying more throughout the investment horizon, like this whole time frame. You're getting a dividend, and rather than spending the dividend or letting it accumulate in cash, if you're, this is where often you'll hear people comparing stocks and gold. People often who sell gold. You hear, well, gold outperforms the S&P 500, but they're comparing the price return of the S&P 500 and the price return of gold. But gold doesn't pay dividends. The S&P 500, the stocks in that index pay dividends. And that's the larger effect of the return. The price return is 1,000 to $500,000. Reinvesting dividends, 1,000 to 7.3 million. And when you account for that, it's not even close. So that's another kind of misconception that I hear, that this fun fact kind of.
Well, and if you think about it, investing in stocks, investing in stock funds, investing in stock exchange traded funds or index funds, any of those, you're buying a fractional piece of actual real life corporations.
Mm-hmm.
Right? So if you're going to go buy a company, like let's say you're going to buy a little business in town, you wouldn't want to buy that business if it didn't have a profit. And when you're buying public companies, those profits are paid to the investor in the form of a dividend. So the dividend really is where all of the good stuff starts. You don't get appreciation in the stock price over the long term if the company's not profitable.
Right. Now, there's the case of some companies that don't pay a dividend. They reinvest it into themselves,
True.
R&D or whatever. These are usually growth companies that are like tech companies.
When you buy that company, you're agreeing to this idea that the profits generated are going to be reinvested in the company.
Yeah, and that
but they have
in
profits.
theory ought to result in greater growth in the long run. But it doesn't always work out that way. They've got to have the ability to pay a dividend if they chose to.
Yeah, companies like Microsoft and didn't for years didn't pay much in the way of dividends.
Yeah.
Apple, companies like that. They do now, but yeah.
Well, let's do another fun fact. This one I thought was interesting that kind of gives perspective to stocks and who owns stocks and the majority of the market, how it's kind of laid out in terms of ownership.
Yeah.
A lot of people think of institutional ownership, and institutional ownership certainly plays an important role, or hedge funds. And they think of the little guy, the average,
or billionaires.
Yeah. They think of sort of the ordinary American as sort of the little guy at the table that doesn't own very much of the overall, percentage of the stock market, at least in public markets. And that's actually not true.
It's not true.
The U.S. households own over 50% of the public U.S. equity markets.
That's us. That's you. That's us. That's mom and pop. That's, and it's been that way for a long time.
And where is this money held? It's through mutual funds, through exchange-traded funds, through individual stock ownership. It's in 401ks. It's in IRAs. It's in individual brokerage accounts.
Pension plans.
In fact, I'm not even certain that pension plans are included there, or if that's a separate institutional owner. But regardless, the point remains the same, that U.S. households own most of the U.S. equity markets. The hedge fund community only owns 2% of the public equity markets. That was surprising to me because you hear about them in the news a lot. You hear about, making, gobs of money and all this stuff. But really they're a less influential player.
Yeah. And maybe from time to time they might be short the market, which means that they've sold shares that they don't even own. They've borrowed shares and sold them.
Yeah,
so,
maybe that takes them from 2% to 1.5% or something like that. But regardless.
It is pretty cool, though, to know that just regular people, you, me, Archie, we are basically the stock market. We are this source of capital that makes American businesses the greatest businesses in the world.
Yeah.
Some of them, a lot of them.
We have an incredibly efficient capital markets, and when a business goes public, they don't have to go to banks for capital exclusively. They don't have to go to private equity firms or private credit firms. They can go to the American people and raise capital through us because they know that we have retirement savings. We need growth in our retirement savings. We have, investment accounts. We need growth there to fund our big objectives. And they need capital. So we can exchange. I'll give you the capital. I'll participate in your growth. We both benefit. And we have a really extremely efficient capital markets. And it's a great thing.
Best in the world.
Yeah. So the name of the game is get into it and participate in that, and it'll make retirement much more attainable.
Greatest wealth creator in the history of man.
Yeah, that's right.
And maybe even more than that, maybe in the whole universe.
Yeah.
I don't want to oversell it, though.
Yeah. Well, I think that's probably all we have. We have lots more here. Maybe one last one that's kind of interesting. Going back to 2008, U.S. GDP was the same size as the GDP of the European Union. Fast forward to today, the U.S. GDP is 50% larger than that of the European Union.
Wow.
So
there's a lot of countries wrapped up in the EU.
yeah, and it's kind of amazing that this is part of why the U.S. stock market has done really well. It probably has to do with the efficiency of our capital markets. The government has borrowed to invest in the private sector quite a bit since then. So it's paid off in GDP growth. So anyway, there's so many more of these. I think we're probably going to do some fun fact episodes, just rapid fire, some interesting tidbits about different aspects of financial planning, about the markets and that sort of thing. So if you like this episode, hit the like button. If you have questions or comments, leave us a comment. Share it with your family and friends. And if you're not subscribed yet, make sure you subscribe to the channel, and we'll look forward to seeing you next time.
You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.